and you should get used to this example because we adjust this example over and over throughout these lecture notes. So on January 1st, 2011, Guyman Inc. leased a stump grinder from Blunck Corporation. So Professor Guyman, how many of you had Professor Guyman in the past? So he's my good friend. So he is leasing a stump grinder from me. And this was on my mind when I was writing this because I just cut down some trees and I needed some stumps ground. And I still haven't done it, by the way. So this was in my mind when I was writing this question. So everyone know what a stump grinder is? Mm-hmm. So you cut down a tree and you have this stump. There's this big machine that grinds up the stump into sawdust kind of, or chips, basically. That's what Professor Guyman is leasing from me. I don't know why. I don't know why I have one, but... Alright, so January 1st, 2011, Guyman Inc. leased a stump grinder from Blunck Corporation. The lease agreement specifies 3 annual payments of $2,000 beginning January 1st, 2011, the inception of the lease, and at each January 1st thereafter through 2013. The useful life of the grinder is estimated to be 6 years. If Guyman purchased the grinder with cash today, he would pay $10,000. If funds were borrowed to buy the grinder, the interest rate would have been 8%. So the first thing we're going to do is determine how this particular lease is going to be classified. And so we're going to look at our 4 criteria. And I'm not going to write them each one out, but we'll just kind of give an idea. So the first one is there a transfer of ownership? No. Did you read anything about a transfer of ownership here?
No.
Okay, if you didn't read anything about one, then there wasn't one. So the answer is no. So it can still be an operating lease. I'm not going to write that out. But if the answer is no, then it can still be an operating lease. Does that make sense? Mm-hmm. Is there a bargain purchase option?
No.
No. There was nothing about a bargain purchase option in this problem. So it can still be an operating lease at this point. The third one, which is the lease term, has to be less than 75% of the life of the asset. So let's figure this one out. So what is our lease term?
3 years.
3 years. And what's the useful life of the asset? 6. So we're at 50%. So does that mean it has to be a capital lease or it can still be an operating? It can still be operating, right? If it's above 75%, then it must be a capital lease. If it's below, it can still be an operating. So we're going to go with no, it's not. Sorry, this should be more. Is the lease term more than 75%? No. Therefore, it can still be operating. Does that make sense? All right. And then the fourth one is the value, the present value of the minimum lease payments, is that less than 90% or is that greater than 90% of the total value of the asset? We'll just call this value greater than 90%? Question mark? Something like that. So now what we need to do is figure out what the present value of the minimum lease payments is, because that's the only way we're going to be able to answer this question. And so let's draw a quick picture to see what this thing looks like. It's going to be for 3 years, and they're making annual payments of $2,000. So here we have 1/1/11. The first payment happens January 1st, 2011. So it's going to be a $2,000 payment here. And then there's going to be a $2,000 payment here, and a $2,000 payment here. So they're going to be paid up front for the upcoming year for each of these 3 years. No payment at the end. So this is an example of what kind of an annuity? This is an annuity due. Remember annuity dues? Does that sound familiar? Okay, so the difference is there's a payment at the beginning and no payment at the end. Okay, so this is an annuity due. So we're going to do the present value of an annuity due. And it's going to be 3 periods, and we are given an annual interest rate of 8%. And we're going to take, and we're going to go to our table for the present value of an annuity due. I don't know what table it is in the textbook. Whatever that table is, we're going to go to that table. And then that will give us well, we need to multiply the payments, $2,000, and this is going to be 2.78326. Is the present value of the annuity due factor at 8%, 3 periods. Does that make sense? Okay, so incidentally, if you didn't want to do an annuity due, you could also do an ordinary annuity. What would you have to do?
Just add 2,000.
You should add 2,000, so it would be for 2 periods. Basically, you would ignore this one, do it for 2 periods, bring those 2 back, and then add 2,000 and do the same thing. So it would be 1 less period, and just add the 2,000 back. So this is going to give us 5,567. And so the 5,567, we're going to compare that to what number? The 10,000, and specifically 90% of the 10,000. So this is going to be less than 90% of the $10,000, or $9,000. And so since it's less, the answer here is no. It is not greater than 90%. So we have no, 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 no. None of these 4 things are true. This can be an operating lease. Okay. So do we have to do anything extra for the lessor? No, because it's an operating lease, there's nothing additional to do for the lessor. Because only if it's going to be a capital lease do we have to do these 2 additional things. So this is going to be an operating lease for both sides. For the lessor and the lessee, this is an operating lease. Any questions about anything you see there? Okay. Now we'll do some journal entries. So we're going to do it from both perspectives. For this particular example, it's super straightforward. So for the first payment, the lessee is going to pay out cash of $2,000. They're not going to record rent expense. Why aren't they going to record rent expense yet?
There was no expense yet.
They haven't used it yet, right? This is the very first day of the year. They haven't used anything. So right now, what do they have? A prepaid rent or prepaid asset. Very good. So prepaid rent of $2,000. The lessor is receiving cash of $2,000. They can't record rent revenue yet. Instead, they have to record what?
Unearned revenue.
Unearned revenue. Very good. All right. We get to the end of the year, we do an adjusting entry. We're going to make another payment 1 day after this. And we might talk about that afterwards, but this is the day before we make that next payment. So basically all we're doing is we're doing adjusting entries to fix these guys, because we don't have this prepaid rent anymore because we've now used it all, and we don't have an unearned revenue because we earned it all. And so we're going to adjust both of these. We're going to debit rent expense for the $2,000 and get rid of the prepaid rent of $2,000, and then get rid of the unearned revenue and record rent revenue 2,000 and 2,000. All right, the very next day they're going to make their next journal entry, and what is it going to look like?
Same thing.
It's going to be exactly the same as this guy right here. And at the end of the next year, they're going to do this again. So these are what they're going to do every single year. January 1st, December 31st, January 1st, December 31st, January 1st, December 31st, and they're done. So it happened 3 times for each one. Every subsequent payment adjusting it will be the same. So very straightforward for operating leases. Did we see the asset change hands?
No.
It didn't, right? The owner kept it on their books. The lessee didn't put it onto their books. All they did was when they paid out cash, they recorded it, and when they had rent expense, they recorded it, and when they had rent revenue, they recorded it. And that's it. That's all that happens with an operating lease. And the operating lease is the off-balance sheet financing. All So if we're talking about off-balance sheet financing, operating lease. Capital leases are not off-balance sheet financing. All right, two last things that are associated with operating leases that we'll just talk about the ideas. Advanced payments. Advanced payments are considered prepayments of rent. They are deferred and allocated to rent over the lease term, usually equally each period. So for example, let's pretend for a second that instead of being 2,000, 2,000, and 2,000, let's say it was 4,000, 1,000, and 1,000. That adds up to the same amount, right? Still 6,000. So, but are we using it more in the first year than the last 2 years? No, we're not. We're using the same every single year. So we wouldn't have 4,000 of rent expense in the first year, and then 1,000 of rent expense and 1,000 of rent expense. That's not what would happen. What would happen is you would still have rent expense equally in all 3 periods. So when you made that cash payment, it would just become a prepaid, and it would stay a prepaid until you actually used it as time passed. Does that make sense? Okay, so in other words, the cash flow has nothing to do with the expense and the revenue. So if all of the cash were paid right here and it was for this period, you'd still spread it between the 3 years. Same idea. All right, so that's advance payments. Leaseholder improvements, very common. Sometimes the lessee will make improvements to leased property that reverts back to the lessor at the end of the lease. Leaseholder improvements are capitalized by the lessee. So let's say, for example, we have this asset and we're going to improve it in some way. We're going to rip out all of the seats in the airplanes and put in new seats. We're putting in a new jet engine. I don't know what we're doing. Something significant to improve this particular asset. If it refers back to the lessor, what the lessee does when they pay for this, instead of just having an expense, they will capitalize the asset and then spread it over the lease term. And so it gets spread over whatever period of time they're going to use the asset.
Yeah, with an advance payment, can you spread it the way you like?
Most things are going to be used evenly over time, so you'd have to spread it evenly. Does that make sense? Yeah. I mean, you could argue in certain cases, kind of like how you'd argue for faster depreciation in some things, you're going to use up more of it early. You could argue that. Most of the time, it's going to be evenly. All right, so leasehold improvements, leasehold improvements are capitalized with the lessee. Like other assets, leasehold improvements costs are allocated as depreciation expense over its useful life of the lessee, which is to be the short of the physical life of the asset or the lease term. All right, we're going to come back to this idea here in a little while. All right, so that is it for operating leases. We are done with one of the 2 types of leases. So what does that mean? That means that the capital lease is the harder one, because we're going to now spend the other 3/4 of today and all of next time talking about capital leases. So capital leases. The amount recorded, capitalized, is the present value of the minimum lease payments. Okay, so first of all, let's back up. With a capital lease, if one of those 4 things are true, it has to be a capital lease, and then we'll deal with the other 2 things the lessor has to make sure. But essentially, the asset is going to be taken off of the lessor's book and put onto the lessee's book. Because the risks and rewards are being transferred, therefore the asset also gets transferred. The value that the asset gets put onto the lessee's books is the present value of the minimum lease payments. Okay, this is an important idea. We're going to do examples of this, but this is an important idea. However, the amount recorded cannot exceed the fair value of the leased asset. This will almost never happen. I mean, I guess it's possible, but it's probably not going to be greater than the value of the leased asset, but it can't go above that amount. If the lessor is not a manufacturer or dealer, the fair value of the leased asset typically is the lessor's cost. We're going to come back to this idea. When the lessor is a manufacturer or dealer, the fair value of the property at the inception of the lease is likely to be its normal selling price. So if you are just a financer, in other words, you take this asset, you transfer this other person, you lease it to them, then the cost is going to equal the fair value of the leased assets. If you are a manufacturer or dealer, so you build this thing, or your purpose of leasing this is to try to make a profit on not just the lease, but basically you'd like to sell it, but they won't buy it without having financing terms, so you essentially lease it to them, but you're really making a profit when you sell it to them. If that's the case, then the normal selling price is the fair value on the date that you start the lease. In calculating the present value of the minimum lease payments, the interest rate used by the lessee is the lower of the incremental borrowing rate or the implicit interest rate used by the lessor. So since we have these two potential things, it's possible that the lessor is using one interest rate and the lessee is using a separate one. And this can actually create, in very specific cases, the possibility that both firms are calling these one's calling it operating lease and one's calling it a capital lease. Because of the present value of the minimum lease payments and you use the interest rate, because those interest rates are different potentially, you could have one call it operating lease and one call it a capital lease. That can potentially happen. It doesn't happen very often, but it is possible. Alright, so the interest rate we're going to use is the lower of these two. In all the problems we ever do in here, I just give you an interest rate. So, very straightforward. Interest accrues at the effective rate of the balance outstanding during the period. So remember, the effective interest method has not gone away. If you have a liability, same thing happens. Lease payments, except the first, include interest on the outstanding balance as well as a residual portion that reduces that outstanding balance. What you're going to find is that, at least for the plain vanilla version, these leases are going to look a lot like the, the installment notes that we did last time. They're going to look almost exactly the same, in fact. And so, that's what they're describing right there. Depreciation is recorded for the lease asset in a manner consistent with the lessee's usual policy for depreciating its operational assets. So, with a capital lease, since the lessee now has assets on their books, they depreciate the asset. With an operating lease, the lessor has the asset, and they go ahead and depreciate the assets just like they normally would. Okay? The one difference is, for the lessee, you're going to depreciate it normally over the term of the lease, not the life of the asset. So you're only going to depreciate the asset over the lease term. So the lease term is 8 years, and the life of the asset is 10 years. If you were the lessee, you're going to depreciate it over 8 years. The exception, which is on the next page, is that you're going to do it over the asset's useful life if there's a transfer of ownership or a bargain purchase option. If those things are true, then essentially the asset you're going to keep anyway, so you're going to depreciate it over its entire useful life. Okay, so if there's no bargain purchase option or transfer of ownership, you depreciate the asset over the lease term. If there is either one of those two things, you depreciate it over the useful life of the asset.
So only one has to be true.
Yes, so yeah, one or the other. Well, I mean, essentially if you have this, this happens.
Okay.
Alright. Now we're going to differentiate between a direct financing capital lease and a sales type lease. And the way you determine if something is a direct financing or a sales type capital lease, by the way, this is specifically for the lessor, the person that owns it but is leasing it to the lessee. A sales type lease requires recording sales revenue and cost of goods sold by the lessor at the inception of the lease. All the entries are the same as in the direct financing lease. All right, here's the difference. The presence or absence of a manufacturer's or dealer's profit distinguishes between a sales type lease and a direct financing lease. In other words, if there is a manufacturer or dealer's profit associated with the lease, then it's a sales type lease. If there is not, then it's a direct financing lease. So the way to think about this is, if the value of this asset is $10 million and the lease value is $10 million, that's a direct financing lease. If the value of this asset is, the way I was going to describe this is not exactly right. Let me back up for a second. Essentially, and I'm going to back up from what I was about to say, because I don't think it's exactly right. if the lessor would normally have a profit associated with the sale of this thing, if it was selling it, then it's going to be a sales type lease. If not, it's a direct financing lease. What I was going to say was mostly right, but not 100% true, so I'm not going to say it now. All right, let's do an example. And by the way, this information from here to the bottom of the page, and then from here to here is very important, and you're going to see it as we work through these problems. And so you're probably going to want to review all of this information from here to the top of the capital leases again, because that's a lot of information in there that we're going to be using